Most people who save $25,000 make one dangerous assumption. They believe the hard part is behind them. It isn't. The real decision happens next, because what you do with that $25,000 over the next decade determines whether it quietly compounds into six figures or slowly loses ground to inflation. In this video, I'm going to show you the exact math behind turning $25,000 into $100,000. No speculation, no unrealistic returns, no market predictions. Just structure, just discipline, just time. And if you understand this framework, you'll stop chasing shortcuts and start building real momentum. Let's begin with why this matters. $25,000 is a psychological milestone. It feels substantial. It took effort. It represents progress. But it's also a danger zone. Because at this level, people typically do one of two things. They get overly conservative, or they get overly aggressive. The conservative path sounds safe. They park the money in cash, earning 2%. After 10 years, $25,000 becomes roughly $30,000. That's a $5,000 gain over a decade. Inflation historically averages around 3%, which means in real purchasing power terms, you may have gained almost nothing. You protected the money, you didn't grow it. The aggressive path looks exciting. They try to double the money quickly. Concentrated bets, speculative assets, market timing. Sometimes that works. Often it doesn't. And one major drawdown can set you back years. The smarter path is structured equity exposure combined with consistent additions. It is not flashy. It is effective. The market rewards discipline, not excitement. Now let's talk about the math. Historically, broad U.S. equity markets have returned roughly 8 to 10% annually over long periods. Not every year. Some years are negative, some years are strong. But over decades, that range has been defensible. Let's use 8%.
Conservative, reasonable, historically grounded. If you invest $25,000 at 8% and add nothing else, here's what happens. After 10 years, you have about $54,000. After 15 years, about $79,000. Around year 18, you cross $100,000. That is without adding a single additional dollar. Just compounding. Quick reset. It takes time, but it works. Now let's improve the structure. Instead of leaving the $25,000 alone, you contribute $500 per month. That's $6,000 per year. At 8% annual returns over 10 years, you reach approximately $135,000. Let's break that down. You contributed $25,000 initially. You added $60,000 over the decade. Total contributions, $85,000. The remaining $50,000 came from growth. That growth came from consistency, not prediction. Now let's make this more realistic. What if $500 per month feels high? Cut it in half. $250 per month. $3,000 per year. At 8% for 10 years, you reach roughly $95,000. Still approaching six figures. The framework scales to your income. Contribution rate changes the speed. The structure stays the same. Now we need to address the most important variable, behavior. Because none of this works if you interrupt it. At some point, markets will decline. Your $25,000 may fall to $22,000, maybe $20,000, possibly lower. That volatility is normal. It is not a flaw in the system. It is part of the system. If you stop contributing during downturns, compounding slows. If you sell, compounding resets. Historically, rolling 10-year periods in U.S. equities have been positive the vast majority of the time. But that assumes you remain invested. Compounding requires time. Time requires emotional control. This is where most people fail. Not because the math doesn't work, but because they cannot tolerate temporary discomfort. The market rewards discipline, not excitement. Now let's clarify risk. This framework assumes a long-term timeline. If you need this money in 2 or 3 years, equities are inappropriate. Short-term volatility can be severe. Allocation must match timeline. That is financial logic. For long-term capital, volatility becomes less threatening. For short-term capital, preservation matters more than growth. Understand the difference. Now, let's discuss taxes and efficiency. If you invest through a taxable brokerage account, you'll owe taxes on dividends and realized gains. That reduces your effective return. Using tax-advantaged accounts improves efficiency. As of 2026, Roth IRA contribution limits are $7,000 per year for individuals under 50. Employer-sponsored 401k plans allow even higher contributions. The goal is to shield growth from taxes whenever possible. Fees also matter. A 1% annual fee can significantly reduce long-term returns. Low-cost index funds minimize that drag. Small percentages compound both positively and negatively. Now, zoom out. Why is $100,000 such an important threshold? Because momentum changes. At $100,000, an 8% year adds $8,000 without additional effort. At $200,000, that same percentage adds $16,000. Growth begins to feel self-propelling. The first $25,000 is effort-driven. The next $75,000 is structure-driven. Once you cross 6 figures, compounding becomes visible, and visibility increases motivation. This is why the first milestone matters. Let's address inflation directly. If inflation averages 3% and your nominal return is 8%, your real return is closer to 5%. That still compounds meaningfully. At 5% real growth, money doubles roughly every 14 years. The goal is not just more dollars, it is more purchasing power. And historically, diversified equities have outpaced inflation over long periods. Now, here is your action plan. First, confirm you have an emergency fund.
3 to 6 months of expenses in cash. That protects your investment strategy from being disrupted by short-term needs. Second, allocate long-term capital into diversified, low-cost equity exposure. Keep it simple. Complexity rarely improves outcomes for most investors. Third, automate contributions. Monthly, on schedule, no decision required. Automation removes emotion. Fourth, review quarterly. Not daily, not weekly. Daily monitoring increases the urge to interfere. Quarterly review keeps you informed without triggering reaction. Fifth, stay consistent during downturns. That is where long-term returns are often built. Now let's close this clearly. Turning $25,000 into $100,000 is not about brilliance. It is not about timing. It is not about predicting recessions. It is about structure. It is about feeding capital into productive assets. It is about giving compounding enough time to work. Most people fail because they want acceleration instead of accumulation. But wealth rarely builds through intensity. It builds through repetition. Allocate, contribute, stay invested, allow time to compound. The math is not dramatic, but it is powerful. In over a decade, that power becomes visible. That is how $25,000 becomes $100,000. And that is how disciplined investors build long-term wealth.